This coming Tuesday sees the latest US CPI report providing a fresh insight into the direction of travel for prices under Donald Trump. Of course, he says that prices remain low and that inflation remaining low should mean that the Federal Reserve are due a rate cut. The likes of Jay Powell think otherwise, and certainly this should give us fresh insights that drive market sentiment as we go forward. So let's get into it. So first and foremost, you can see here in terms of the data on Tuesday, markets are expecting inflation to remain relatively subdued for the time being. 0.2% on the month-on-month figures, both expected. Now, notably, when we look at these inflation reports, generally people always look at the big ticket items. So 2.8% previously on the core figure, 2.4 in the headline. That's really where people care about it because, of course, the target for the Federal Reserve is to bring inflation down towards that 2% area. Now, that generally is geared up towards a core PCE price index metric, but inflation on the CPI front, also very important to be following. And so you can see here, 2.4 expected to rise to 2.5, 2.8 expected to rise to 2.9, but when you look at the ins and outs of it, ultimately you're looking at 0.1 going to 0.2. Now, as long as inflation on a monthly basis is around 0.1 to 0.2, you're on target for that 2% target. Of course, 12 months in the year, so as long as you're remaining around that 0.2 mark, 0.1, then it's somewhere around 2%. Things get problematic when you see monthly inflation metrics of, say, 0.4 and things like that. Note the 1% rise that we saw in terms of UK inflation not so long ago. So these numbers are not troublesome despite the fact that we're seeing a rise in terms of both of the year-on-year metrics, and that comes down to so-called base effects. If we do see a rise in terms of the year-on-year figure, but the monthly figures are relatively low, that rise in the year-on-year figure comes down to base effects, where essentially the figure that's being switched out, so the figure from a year ago, the monthly figure that's being replaced, that might have been very low. Let's say that was at 0% and the new monthly figure 0.2. Then you'd see a rise in terms of the year-on-year metric, but it's not necessarily a troubling one because that 0.2 figure still remains relatively low and essentially on target. Now, something we have seen recently is weakness in terms of inflation. You can see it here within the 3-month annualized chart that I've produced. A number of different ways of sort of cutting up inflation. And you can see here, I've sort of cut it up in a number of different ways when we're looking at the likes of core CPI or just shelter or just core excluding shelter or services excluding shelter. Remember, shelter is a massive component of CPI. Core PCE or the headline CPI number, lots of different ways of looking at it. All of them on a 3-month basis have dropped recently. So essentially the trajectory seen over the past 3 months, if that was projected out for a whole year, where would that take us? And many of these are around or below the 2% target. So certainly you can see why Donald Trump is saying, look, inflation's under control. Why don't you start cutting interest rates? But that is a short-term phenomenon. A lot of it comes down to sort of uncertainty and economic weakness that comes with the uncertainty that is provided by Donald Trump under his current sort of tariff outlook or policies. And once we do see that policy coming into play, if we see a sharp rise in terms of tariffs, that in my mind is likely to cause inflation. Certainly Jay Powell has alluded to this. He thinks inflation is around the corner with the policies undertaken by Donald Trump. That may or may not be the case. If it is the case, then it points towards a potential for the Fed to continue to hold off. But then it really does provide the basis for that conversation where there's the argument of a temporary one-off inflationary shock, and therefore we should continue to cut rates versus, a surge in inflation. And that means that given the dual mandate of the Federal Reserve, they should hold off. So that conversation comes down the line, but certainly markets are very sensitive to inflation data at the moment if we were to see a resurgence. Like I said, if we're looking at that 3-month annualized figure, things are coming down in a meaningful way. And you can see why here. The two blue columns are for core CPI and CPI. The sort of orangey, yellowy one is core PCE. And these are monthly figures. So this gives you a good idea of exactly how sort of monthly inflation has built up or pulled back over different periods of time. You can see at the back end of last year, coming into the beginning of this year, inflation really rearing its head once again. But over the course of March, April, May, inflation has been relatively subdued, and between that 0 to 0.2 mark, which is exactly where we need to be if we're to get year-on-year inflation back to 2%. Now, one of the sort of precursors to seeing inflation rise is how are we seeing businesses reacting? How are we seeing the conditions for businesses? And the ISM PMI figures are a really good way of looking at this. It's a leading indicator where we can essentially see actors within these sectors sort of providing commentary and reflecting what they're seeing on the ground. Now, the good thing about the ISM ones, as opposed to just the headline PMI numbers, is that ISM numbers provide you with breakdowns in terms of specific PMI figures for different things, the likes of new orders, the likes of employment, and crucially, the likes of prices. So what we've done here is provided the manufacturing and the services PMI numbers with just the prices paid elements, and then providing a 6-month lag for the rest of them. So we've got here the sort of CPI figure on a year-on-year basis, the 3-month annualized CPI, and the 6-month annualized. So it's sort of showing you inflation over the long term. But like I said, the year-on-year CPI figure is very lagging in nature. If you see a big pop on the monthly figure, it's not going to factor into the year-on-year figure in the same way as it would with the 3-month annualized. So crucially, we'll be looking at that sort of red line, which is at the bottom here, but then looking at that compared to the likes of the light blue line and the dark blue line. The light and the dark blue line show that there has been a perceived surge in terms of price pressures for businesses within manufacturing and services, but we haven't necessarily seen that show through into the data itself. Are we going to see inflation rear its head once again at this report? If it does, then it'll be a surprise because markets aren't expecting it. And that, in my mind, is the biggest risk here. The risk to inflation falling more than expected is minimal in my mind because markets at the moment are at record highs anyway. And so they're already pricing in a relatively positive sort of scenario for the economics associated with the US, with the trade war, things like that, right? If we were to see a surge in terms of prices, that, given the expectation that we're not going to see that, would be a major concern for markets. Here's a breakdown in terms of where we stand in terms of core and headline CPI, 2.4, like I said, and 2.77 on the core figure. Notably, you've got that breakdown in terms of the month-on-month figures. As I said, the last 3 to 4 months, really, we've seen it sort of under control, given the uncertainty that have been brought by Donald Trump. And then I've got the sort of 10-month annualized. So, where are we if we move a couple of months down the line? And that sort of does a good job of trying to essentially strip out the next couple of months when it comes to base effects. So that points towards a potential rise coming into play. And you can see why we could see a rise. And like I said, year-on-year inflation is expected to rise. Why is that happening? Well, you can see the base effects are likely to come into play this time, because if you look at the left-hand section of the middle part, the month-on-month section, you can see what's dropping out. We can see that the core figure that's dropping out is 0.1 and the headline figure is 0%. So essentially, if we see a core figure above 0.1 and crucially a headline figure above 0.0, so essentially 0, on the monthly figures, it points towards upside movements for core and headline. More likely is a rise for the headline figure because it's 0% last year, but of course, headline inflation also includes that downward pressure that we've seen for energy prices, which does sort of help things along a little bit. In terms of market expectations, the July rate cut is essentially off the table for me. The decision to push back that tariff deadline to August the 1st, essentially, in my mind, just rules out the idea we're going to see a rate cut. Too much uncertainty for the Fed. Where's the movement going to happen? Well, as you can see here, over the course of the past day, week, and month, we've seen very little change in terms of market expectations for rate cuts over the course of this year. So this is essentially where a rate's going to be by the end of the year, by the December meeting, December 2025. Markets now currently pricing essentially the base case scenario has been 2 rate cuts, so a move down to that 375 to 400 band. And then beyond that, the second most likely is 3 rate cuts, 350 to 375. So most likely is that if we see some change in terms of sentiment, it's going to be a move away from those 3 rate cuts and perhaps towards the 2 rate cuts or the 1 rate cut. And that would be if we saw inflation coming in relatively hot this time around. Of course, the Federal Reserve expect it to heat up at some point. We don't know if it's going to happen right now or maybe a few months down the line. And by and large, it might be a case of, 10% tariffs. Some businesses can swallow a decent chunk out of that, and then consumers pay a little bit of it. But when you start seeing countries potentially getting hit with 25%, 35%, 50% tariffs, that's when you really see the potential for a shock in terms of inflation. So do we see that coming into the fore quite yet, or we'll see inflation hold off once again? Let's just take you through a few charts. First and foremost, I wanted to show you the chart for the Nasdaq. So the Tech 100, of course, reaching a record high once again. The tech names are always going to be at the forefront of a market rally, and a lot of the time they're also at the forefront of the market sell-off, just because people like to, those are the most heavily invested stocks essentially. So when people jump back into the market, they jump into those big tech stocks. When people sell off, they look at, what are the most heavily valued stocks. The PE ratio on these big tech names are absolutely massive. So people think they're overvalued and are quite quick to jump out of them. And then if people are selling ETFs or products that are essentially covering the entire markets, well, the heavy weighting for these big tech names will mean that generally they get hit as a result. The Nasdaq 100 is the index that is very heavily geared towards those tech stocks. So you would think it would outperform at times of strength, but question marks at times of weakness. Will it hold up well when we see weakness for some of the other sort of pro-cyclical names, or will we see the big tech names sort of rolling over? That part is less clearly defined. For the time being, we have been regaining ground, but you can see here, yes, we've rallied into record highs, but we're sort of slowing down a bit here. If you look at the sort of top end of this move, let's just try and get that out of the way and get these lines drawn on. There we go. Now we can get rid of it entirely. So we can see here, right? So that strong rally, then retracement, rally into maybe an extension of essentially like, a bit less than 100% of that initial pullback. Then the next move, right? We saw a decent pullback, maybe 61.8 fib, and then just a really tentative high there. And now we're pulling it back into another deep pullback. So, or deep retracement. The question mark here is, are we retracing before the bulls come back into play once again? That remains to be seen. At the moment, we are respecting the 76.4 fib, which is 22679. But like I said, I think the risk for that inflation report is geared towards the downside, because if we see a hot inflation number, then we could see this start to roll over. If we see inflation coming in weak, then people can just disregard it and say, well, next month, that's when the inflation number is going to start to turn upwards. So I think this is at risk. At the moment, we're holding up at fib support. If we break the 22600, that's when it starts to look like we could give back some of this big rally that we've seen since the sort of 22nd of June. So yeah, we're still within that near-term intraday uptrend, but certainly starting to bring questions with the tentative highs and the very, gradually deeper retracements that are forming for the Nasdaq 100. When it comes to the dollar index, we've actually been seeing the greenback regaining some ground recently. That being said, you can see we're set within a very clear downtrend here, and that still does continue to play out. That downtrend has retracement phases built within it. Some are sort of protracted in nature. Some are sort of 1 or 2 day affairs. Some last a week or so. We're somewhere in the middle at the moment. We're coming back towards this descending trend line. So keep a close eye out for this. If we see hot inflation coming out, we could start to see the US dollar strengthening a little bit off the back of that. But, I would say that everything that's going on around tariffs, around US debt, under the so-called big, beautiful bill, things like that, it's not a great time to be long the US dollar in my mind. Yes, there was always a good chance that with a strong move lower at some point, you were going to come into a retracement phase. That's what it looks like we're doing at the moment. And I'd be careful around this 98267, 61.8 fib alongside that descending trend line. That kind of confluence looks interesting for me. And then we'd start looking at, say, the intraday basis and saying, well, very clear-cut trend of higher highs, higher low. If we break out from that after respecting fib resistance, that's when it starts to look a little bit more bearish. So 97,555 is the near-term swing low worth watching out for. And finally, gold doing very well. A number of reasons for this. US dollar weakness has helped things. We've, of course, got fears around debt and the devaluation of currency down the line, with rate cuts coming into play. Now, notably, gold breaking out at a time where equity markets are holding up well. We've also got the US dollar starting to strengthen a bit. We've got question marks about how much the Fed will cut this year, because some Fed members are saying they don't even see a rate cut this year. Gold breaking higher despite all of that. So certainly innate strength shown here for gold, and the pullback that we've seen come and then rally up through the 3345 points towards the possibility of us pushing onwards and upwards from here. We've seen quite a bit of chop recently, and so this period of consolidation looks likely to continue for the time being until we get into a phase where possibly we're more confident about the direction of travel for interest rates and the potential for further rate cuts. But nonetheless, that's not holding things back at the time being, or for the time being. And certainly the daily updates around, more and more tariffs. Today it's 35% tariffs on Canada that's hitting up the news wires. That provides the basis for people to think, the US assets not a great place to be at the moment. And so haven assets, despite the strength we're seeing and the record highs for like the Nasdaq and the like, still look very interesting. And as you can see here, this ascending trend line once again playing in for gold, holding things up. And so, for me, I continue to be positive for gold. And the good thing about gold is when the conditions are good for it, it's been doing incredibly well. And when the conditions aren't that great for it and questionable, it's just kind of consolidated and moved sideways, almost like it's waiting for that opportunity to burst higher once again. So I hope this has been useful. Make sure to like, subscribe, and follow for more content like this. Other than that, have a great weekend and a great week ahead. My name's Joshua Mahony, Chief Market Analyst at Scope Markets.